Disclaimer.
54 nations. One goal: end China's stranglehold on silver. President Trump just signed the order that changes the rules of precious metals ownership forever. Beijing is panicking. The big banks are scrambling, and your physical silver is about to become the most strategic asset on the planet. Here's why the next 48 hours will determine the fate of your wealth. But before we talk about what Trump just triggered, you need to understand the move that started this whole chain reaction. Because what happened in Shanghai 3 weeks ago set the stage for the biggest precious metals confrontation between America and China in modern history. Picture this: January 29th, 2026. Silver just touched $111 an ounce, and somewhere in Shanghai, a Chinese billionaire named Bian is placing the biggest bet of his career. We're not talking about a few million here and there. This guy stacked 30,000 contracts on the Shanghai Futures Exchange, representing 450 tons of physical silver worth $300 million. And he's betting it all crashes. Here's what should grab our attention. Bian didn't just throw darts at a board. This is the same trader who made $3 billion on gold positions over the past few years, according to Bloomberg's tracking of Chinese commodity markets. The man has a track record, and when someone with that kind of success puts down $300 million on a single directional bet, you pay attention. What happens next is where things get interesting. Within days of Bian building his short position, silver doesn't just decline, it collapses 40% in less than 2 weeks, dropping from that $111 peak all the way down to $64. Think about what that means for your investment portfolio if you held silver ETFs or mining stocks. Think about the retirement accounts that got hammered. But for Bian, that crash just printed him another fortune. Now here's where the timeline gets suspicious, and I mean really suspicious. On February 2nd, just 4 days after silver peaked and started its freefall, President Trump announces something called Project Vault. $12 billion dedicated to stockpiling 60 critical minerals. And guess what's on that list? Silver. The White House press release specifically names silver as essential for national security, for defense systems, for the technology that keeps America competitive. But Trump doesn't stop there. 2 days later, on February 4th and 5th, representatives from 54 nations gather for what the Commerce Department calls an emergency summit. They're creating something called the FORGE framework. That stands for Framework for Organized Resource Guarantee and Exchange. According to official statements from the Office of the U.S. Trade Representative, this framework is designed to establish reference prices for critical minerals and prevent market manipulation through coordinated government action. Pop quiz: what are the odds that the world's most powerful nation organizes 54 countries to stabilize mineral prices in the exact same week that silver experiences its most violent crash in modern history? You're thinking the same thing I am, that timing is no coincidence. Let me paint you a picture of what our government is actually doing here. J.D. Vance, our vice president, spelled it out pretty clearly in his prepared remarks at the Forge Summit. He said the goal is preventing China from flooding markets with cheap minerals to undercut domestic manufacturers. The framework creates these reference prices at each stage of production, and governments can use adjustable tariffs to maintain those floors. Within days of the announcement, the State Department confirmed bilateral deals signed with 11 countries, including major producers like Peru, Canada, and Australia. Think about that mechanism for a second. We're essentially telling the world, here's the minimum price we're willing to accept for these materials, and we've got the economic muscle to enforce it. That's not free market capitalism. That's strategic resource warfare disguised in diplomatic language. Now, while Trump's organizing this 54-nation coalition and announcing $12 billion stockpile programs, let's talk about what's actually happening in the physical silver market. Because here's where the story stops making sense, unless you understand what's really going on beneath the surface. The COMEX, that's the New York Commodities Exchange where silver trades, just lost 33.45 million ounces in 7 days. That's 26% of their entire registered inventory gone. When you see that kind of withdrawal, somebody's demanding physical metal and pulling it out of the exchange system. According to CME Group's daily warehouse reports, we haven't seen inventory drain this fast since the 2011 silver squeeze. Over in Shanghai, where Bian made his bet, warehouse stocks just hit their lowest level since 2015. The Shanghai Futures Exchange publishes weekly inventory data, and the numbers are screaming shortage. We're talking about a market that should be flooded with cheap silver if Bian's bet was based on fundamentals, but instead, the physical warehouses are being drained. Here's a number that should make your head spin: silver lease rates. These are the interest rates that bullion banks charge to lend physical silver to industrial users or short sellers who need to deliver metal. Under normal market conditions, lease rates sit around 0.5%, maybe 1% if things get tight. According to data from the London Bullion Market Association, lease rates just exploded from 0.5% to 8% in a matter of days. You know what 8% lease rates mean? Desperation. That's the cost of borrowing silver when there's barely any available to borrow. If you're short and you need to deliver physical metal, you're now paying 8% annual interest just to source it. And that's if you can even find a lender willing to part with their inventory. Let me connect this to something you can understand. Imagine you're planning a vacation to Europe, and you need to exchange your dollars for euros. You check the exchange rate online, and it says $1 gets you 0.90 euros. Pretty standard. But when you walk into every currency exchange booth at the airport, every single one has a sign that says, "Sorry, no euros available." That's the situation in silver right now. The paper price crashed 40%, but try to actually buy physical silver, and dealers are either out of stock or charging massive premiums. Speaking of dealers, I've been checking with bullion retailers across America, and the story is the same everywhere. Bullion Star, a major dealer in Singapore, reported on their public blog that they're seeing unprecedented supply tightness. SD Bullion, one of the largest online precious metals dealers in the United States, has wait times stretching weeks for common silver products. The Royal Canadian Mint is 1 ounce silver maple leaf coins, historically one of the most available products in the world, are showing out of stock on dealer websites from coast to coast. So let's review what we know so far. A Chinese billionaire with a proven track record places a $300 million bet that silver will crash. Days later, it crashes exactly as he predicted, falling 40%. In the exact same time frame, President Trump announces a $12 billion critical mineral stockpile program featuring silver, then immediately convenes 54 nations to create price floor mechanisms. Meanwhile, the physical market is showing every signal of extreme shortage. Vanishing inventories, exploding lease rates, dealer stockouts across the globe. You're probably asking yourself, how can silver's price crash while physical supply is disappearing? How can Bian make a fortune betting on lower prices when the actual metal is becoming scarce? And most importantly, what does Trump's suspicious timing really mean for the silver market and for your money? Here's what you need to understand. What we're witnessing is not just a normal commodity cycle or a case of one trader getting lucky. According to analysts at the World Gold Council and silver market researchers, we're watching a coordinated play that involves government policy, strategic resource control, and a potential short squeeze that could dwarf anything we've seen in commodity markets. The paper price of silver and the physical reality of silver have completely disconnected, and when that happens in any market, something has to snap back into alignment. The question isn't if, but when, and whether Bian Ximing's $300 million bet just walked him into the biggest trap of his career. Because here's what the Chinese billionaire might not have calculated. When you short a market and governments decide that market is suddenly a matter of national security, you're no longer playing against other traders. You're playing against the full force of coordinated state power, and the United States just signaled to 54 nations that we're willing to use every tool at our disposal to control critical mineral prices. That crash Bian profited from? It might turn out to be the setup for the most spectacular reversal in commodity history. And everything, from the timing of Trump's announcements to the disappearing physical inventories to those screaming lease rates, suggests the squeeze is already beginning. Now let's talk about the actual mechanics of what Trump just constructed. Because this Forge framework is not just diplomatic theater, it's a sophisticated price control mechanism that fundamentally rewrites how critical minerals trade globally. And the details matter, especially if you're holding silver or mining stocks in your portfolio. According to the full text of the Forge agreement released by the Department of Commerce, the framework establishes reference prices at 4 distinct stages of the supply chain: mine extraction, refining, fabrication, and final product manufacturing. Here's how it actually works in practice. Each participating nation agrees to maintain minimum pricing at these stages, and if market prices fall below the reference level, governments can deploy adjustable tariffs on imports to bring prices back up. Let me give you a concrete example. Say the Forge reference price for refined silver is set at $75 per ounce, but Chinese refiners start dumping material at $60 to undercut American producers. Under the framework, our government can immediately impose a $15 per ounce tariff on Chinese silver imports, effectively neutralizing their pricing advantage. The Treasury Department has confirmed they are establishing a critical minerals trade office specifically to monitor and enforce these mechanisms in real time. J.D. Vance didn't mince words at the summit when he explained our government's intentions. In his prepared remarks, which you can read in full on the White House website, he stated, "For too long, we've watched as the Chinese Communist Party weaponizes its control over critical mineral supply chains, flooding markets with artificially cheap materials to bankrupt our domestic producers, then restricting supply once they have monopolized production. That ends now." Think about what he's really saying there. Our government is openly admitting that China has been using commodity prices as economic warfare. And we're building a defensive system to fight back. This isn't conspiracy theory. This is official United States policy, stated clearly by the Vice President in front of 54 nations. Within 72 hours of the summit ending, the State Department announced bilateral agreements signed with 11 countries: Peru, Australia, Canada, Mexico, Poland, Chile, Bolivia, Argentina, Kazakhstan, South Africa, and surprisingly, Saudi Arabia. Each agreement includes specific commitments to honor forge reference pricing, coordinate export policies, and in some cases, restrict sales to non-participating nations, including China. Here's where the math gets really interesting for us as American investors and citizens. Let's talk about the structural deficit in silver that makes this whole situation a powder keg waiting for a spark. According to the Silver Institute's World Silver Survey, we've now experienced 5 consecutive years of supply deficits in the global silver market. From 2021 through 2025, the cumulative shortage totals 820 million ounces. That's not some abstract number. That's 820 million ounces of demand that couldn't be met by new mine production and had to come from existing stockpiles, scrap recycling, or drawdowns of warehouse inventories. The 2025 data is particularly striking. The Silver Institute projects industrial demand alone at 550 to 600 million ounces for the year. Total global mine production? Only 820 million ounces. Now do the math with me here. If industrial users need up to 600 million ounces and total production is 820 million, that leaves just 220 million ounces for everything else: investment demand, jewelry, silverware, coins, and bars. But here's the problem. Investment demand in 2025 ran approximately 250 to 300 million ounces according to metals consultancy CPM Group. You see the issue? The numbers don't add up unless existing stockpiles keep draining, and those stockpiles are now hitting critically low levels after 5 years of deficits. Then, China dropped a bomb that most mainstream media completely ignored. On January 1st, 2026, Beijing implemented comprehensive export restrictions on processed silver under their new critical minerals export control regulations. The Ministry of Commerce announcement specified that all silver exports now require special licensing, with priority given to essential national security and economic development needs. What does that actually mean in ounces? China has been exporting approximately 120 million ounces of silver annually to global markets, according to Chinese customs data compiled by the China Non-Ferrous Metals Industry Association. That supply just got choked off or severely restricted right as we're entering the 6th consecutive year of global deficits. If you're an industrial manufacturer in America or Europe who depends on Chinese refined silver, you're now scrambling to find alternative sources in a market that's already short. Our government saw this coming, which explains why Trump moved so fast with Project Vault and the Forge framework. In December 2025, just weeks before China's export restrictions kicked in, the U.S. Geological Survey officially designated silver as a critical mineral for national security purposes. That designation unlocked special authorities for the government to stockpile, subsidize domestic production, and restrict exports if necessary. The Department of Defense issued a 70-page report, you can find it on the DoD website, detailing silver's essential role in military applications, missile guidance systems, radar installations, electronic warfare equipment, naval ship components, and advanced communications infrastructure. The report concludes that current domestic production and readily available foreign supply are insufficient to meet national defense requirements in a prolonged conflict scenario. Translation: our military-industrial complex needs silver, and we don't have enough of it under secure American control. That's why this became a national security issue practically overnight. Now let's dive into the paper versus physical disconnect, because this is where the data becomes absolutely wild and shows you what's really happening beneath the surface of that 40% price crash. You know how silver trades in 2 parallel universes? The paper market, where contracts change hands electronically, and the physical market, where actual metal moves in armored trucks? Well, those 2 universes just completely diverged, and the evidence is screaming from every corner of the physical market. Start with ETF short borrow costs. When you short a silver ETF like SLV, you need to borrow shares to sell. Under normal conditions, the cost to borrow those shares runs maybe 1% to 2% annually. According to data from Interactive Brokers and other major prime brokers, silver ETF borrow costs hit 10% in the last week of January and have stayed elevated. At some brokers, shares aren't available to borrow at any price. The inventory is simply zero. Think about what 10% borrow costs mean. If you're short silver ETFs, you're paying 10% per year just to maintain that position, on top of any price risk. That's not the behavior of a market that's bearish and oversupplied. That's the behavior of a market where physical demand is so intense that even paper proxies are becoming scarce. The premium situation at physical dealers is even more revealing. I've been tracking premiums daily across major bullion retailers, and what I'm seeing is unprecedented. SD Bullion, JM Bullion, APMEX, these are the largest online precious metals dealers in America, are currently paying $55 per ounce over spot price just to source 1,000-ounce silver bars from wholesalers. Let me put that in perspective for you. When silver crashed to $64 on paper, dealers were paying $119 per bar in the wholesale market to actually get physical delivery. That's an 86% premium over the supposed market price. If silver is really worth $64 and there's plenty of supply, why would professional dealers pay double that to get their hands on it? The Royal Canadian Mint, one of the world's largest sovereign mints, is currently showing 4 to 6 week delays on silver maple leaf coins, according to their authorized dealer network. The Perth Mint in Australia suspended sales of certain silver products entirely for 10 days in early February, citing unprecedented demand and global supply chain constraints. These are government-backed mints with direct access to refining capacity, and they can't keep silver products in stock. Here's a data point that technical traders need to understand: backwardation. In normal commodity markets, future delivery contracts trade at a premium to spot price because of storage and financing costs. That's called contango. But silver just went into backwardation on both COMEX and London markets, meaning near-term contracts are trading higher than future delivery contracts. According to London Bullion Market Association data published daily, 1-month silver forwards are trading at a premium to 6-month forwards. That is a screaming signal that market participants need physical silver now and are willing to pay up for immediate delivery versus waiting. Backwardation in precious metals historically predicts major price spikes because it indicates physical shortage conditions. The CME Group's COMEX warehouse data tells the same story from a different angle. Registered silver, that's the metal actually available for delivery against futures contracts, fell from 128 million ounces in mid-January to 94.55 million ounces by February 5th. That's a 26% decline in 3 weeks. But here's the really interesting part. Eligible silver inventory, which is metal stored in COMEX warehouses but not currently available for delivery, also dropped significantly. Total COMEX silver stocks fell from 352 million ounces to 307 million ounces. Somebody is pulling metal out of the entire COMEX system, not just converting it between eligible and registered categories. Over in Shanghai, the situation is even tighter. Shanghai Futures Exchange silver inventories hit 412 tons as of February 4th. That is the lowest level since May 2015, according to exchange data. And remember, this is the same exchange where Bian built his massive short position. He's betting prices go down while the physical warehouse he's theoretically selling from is being drained at historic rates. I've been speaking with bullion dealers off the record, and they're telling me things that aren't making it into official reports. One major wholesaler who supplies dealers across the Midwest told me his supplier network is showing unprecedented tightness, with spot premiums that would shock retail investors. Another dealer in Texas said they are seeing wealthy individuals and family offices buying up all available inventory at premiums that make no sense unless you believe a major supply crisis is coming. The refineries are confirming the same story. According to industry sources cited by Metals Focus, a London-based precious metals consultancy, several major silver refineries in Europe and North America are running at full capacity with order backlogs stretching 8 to 12 weeks. Under normal market conditions, you can get refined silver in 2 to 4 weeks. We're now at triple that timeline. Think about the implications for Bian's short position. He sold 30,000 contracts, representing 450 tons of silver, betting the price would fall. The price did fall on paper, so his trade shows a profit. But in the futures market, he eventually has to either close that position by buying back the contracts or actually deliver physical silver if he gets assigned. Here's his problem. How do you close a 450-ton short position in a market where physical inventories are vanishing, lease rates are at 8% premiums are exploding, and governments just formed a 54-nation alliance specifically to prevent prices from falling further? The answer is very carefully or not at all. And if Bian can't close his position smoothly, and if other large shorts are in the same boat, we're looking at the setup for a forced liquidation event that could send prices vertical. Our government knows this. Trump's team knows this. That's why they moved so quickly with Project Vault and Forge. They're not just trying to support domestic mining, they're positioning America to benefit when this short squeeze detonates, and they're making sure we have secured physical supply before the panic buying begins. Let's do the math on Bian's position, because when you actually run the numbers, you realize he just walked into a trap that might be impossible to escape without triggering the exact price explosion he bet against. At current silver prices around $73 per ounce, and remember prices have bounced back from that $64 low, Bian's short position is sitting on a paper profit. He sold at or near $111, the market crashed to $64, and even with the recent bounce to $73, he's still showing roughly $38 per ounce in profit across 30,000 contracts. Do the multiplication. 30,000 contracts times 5,000 ounces per contract times $38 equals roughly $570 million in unrealized gains. Sounds great, right? Except there's a massive problem that commodity traders call the delivery squeeze, and Bian is staring right at it. In futures markets, most traders close their positions by buying offsetting contracts before expiration. You don't actually deliver physical metal, you just settle the cash difference. But when physical supplies are tight and buyers demand delivery instead of cash settlement, shorts get trapped. Here's Bian's nightmare scenario. To close his 30,000 contract position, he needs to buy back 30,000 contracts in a market that's already showing severe physical stress. Those contracts represent 450 tons of silver. Remember, each contract is 5,000 ounces. According to the Shanghai Futures Exchange's latest delivery data, the entire exchange only delivered 680 tons of silver in all of 2025. Bian's position alone represents 66% of last year's total delivery volume. Now factor in the timing. Silver futures operate on delivery months, certain months throughout the year when contracts mature and can be delivered. The next major delivery months on Shanghai Futures Exchange are March and May 2026. According to exchange rules, Bian either needs to close his position before first notice day of those delivery months, or he could be forced to deliver actual physical silver to buyers who stand for delivery. But here's where the math becomes impossible. How do you source 450 tons of physical silver in a market where lease rates are at 8% and climbing? Let's talk about what those lease rates actually cost. At 8% annually, if Bian needs to borrow silver to maintain his short position or make deliveries, he's paying approximately 40 basis points per month. That might not sound like much, but annualized, it's a 40% cost of carry and interest alone. Think about that for a moment. Even if silver prices stay flat, Bian is hemorrhaging money every month he keeps this position open due to lease costs. And if prices start rising while he's paying 8% to borrow metal, he's getting crushed from both directions. Mark-to-market losses on the short position, plus massive borrowing costs. The professional risk managers at major banks use something called stress testing to evaluate positions like this. According to risk models used by precious metals desks at institutions like JP Morgan and HSBC, a short position of this size in a market showing backwardation and rising lease rates has what they call convex risk. Losses accelerate exponentially if prices move against you because borrowing costs spike in parallel with price increases. I spoke with a former comics floor trader who now runs a commodity fund, and he put it bluntly, a 450-ton short in this market environment is financial suicide if physical supplies stay tight. The moment other large shorts realize they can't source metal, everyone rushes for the exit simultaneously, and that's when you get a moonshot in prices. Now, let's talk about what price levels actually matter from our government's perspective, because this is where Trump's strategy becomes crystal clear. The United States needs silver prices high enough to restart domestic mining operations that were shut down over the past decade due to low prices making them economically unviable. According to a comprehensive analysis by S&P Global Market Intelligence, there are currently more than 60 silver mining projects across North America and Europe that are either on care and maintenance status or were abandoned entirely due to silver prices falling below production costs. These include major deposits in Nevada, Idaho, Montana, Colorado, Alaska, and several Canadian provinces. The all-in sustaining costs for primary silver mines, that's the full cost including exploration, development, extraction, processing, and corporate overhead, ranges from $35 to $50 per ounce for most North American operations, according to CRU Group's mining cost database. But here's the critical detail. That's for mines that are already operating. To restart an idled mine or develop a new deposit, you need silver prices substantially higher to justify the capital investment and provide adequate returns to investors. Mining industry analysts at Wood Mackenzie estimate that silver needs to maintain prices above $45 to $50 per ounce minimum for at least 2 to 3 years before companies will commit the hundreds of millions required to bring shuttered mines back online. And for new greenfield projects, you're looking at requirements closer to $65 to $75 to meet internal rate of return thresholds that mining companies demand. Project Vault's $12 billion appropriation is specifically designed to create that demand floor and price support. According to the Department of Energy's Critical Mineral Strategy, document released alongside the Project Vault announcement, the government plans to purchase and stockpile silver aggressively over a 3 to 5 year period targeting acquisitions when prices dip below defined levels that make domestic production viable. Here's where it gets specific. The DOE document references strategic price corridors for each critical mineral, though exact numbers are classified for market sensitivity reasons. However, industry sources cited by Bloomberg suggest the Trump administration is targeting a silver price floor in the $75 to $85 range to incentivize the restart of at least 20 major domestic projects within 18 months. Think about what that means. Our government is essentially telling the market, we won't let silver fall below the level needed to support American mining. That's a put option under the market, funded by $12 billion of taxpayer money and backed by the coordinated support of 54 nations through Forge. Now let's look at where prices could actually go if this squeeze plays out, because the analyst projections are frankly shocking. CPM Group, one of the most respected precious metals research firms, released a note to clients in late January projecting silver prices could reach $100 to $150 per ounce during 2026 under their base case scenario. Their bull case, which assumes full implementation of Forge price supports combined with continued physical shortage conditions, targets $200 to $250. Metals. Focus, the London consultancy I mentioned earlier, is even more aggressive. Their lead analyst told Reuters in an interview published February 3rd that a sustained move above $200 is not only possible but probable if governments follow through on stockpiling commitments and if Chinese export restrictions remain in place. The Silver Institute updated their annual forecast on February 1st, and while they're more conservative, they still project an average price of $95 to $110 for 2026, with potential spikes to $150 if supply disruptions intensify or investment demand accelerates beyond current expectations. Even the historically bearish analysts at Goldman Sachs revised their silver forecast upward on January 28th, literally the day before Bian made his short bet. Goldman now projects silver averaging $85 to $95 through 2026. Citing structural deficits, industrial demand growth, particularly in solar and electronics manufacturing, and increased strategic government purchases. Have you noticed what's interesting about all these forecasts? They were published before or immediately after the 40% crash, which means professional analysts looked at that price decline and said, this doesn't make sense given physical market fundamentals, and prices are going substantially higher. That's not speculation. That's professional research firms with decades of commodity market experience telling their institutional clients that the crash was a buying opportunity. Let's talk about the timeline convergence that makes this situation so explosive. Bian's short position needs to be addressed before the March and May delivery months on Shanghai Futures Exchange. According to exchange rules, first notice day for March contracts falls on February 26th, and for May contracts, it's April 25th. That means Bian has roughly 3 weeks for March and 11 weeks from May to either close these positions or prepare to make physical delivery. During that exact same time window, Trump's Forge price floor mechanisms are scheduled to activate. According to the Commerce Department's implementation timeline, the first phase of reference pricing and tariff adjustments takes effect March 1st for refined silver and silver-bearing concentrates. The second phase, covering fabricated silver products, activates April 15th. You see the collision course? Bian needs to exit his short position right as the U.S. government and 54 allied nations implement price support mechanisms specifically designed to prevent silver from trading below profitable mining levels. It's like trying to escape a burning building just as firefighters are sealing all the exits. The physical shortage signals are intensifying daily. I've been monitoring dealer inventories across North America, Europe, and Asia, and the situation is getting more extreme, not less. Bullion Star, the Singapore-based dealer with excellent market commentary, published a blog post on February 4th stating they are experiencing the most severe supply tightness in our company's 15-year history, with premiums on certain products reaching levels that would shock retail investors who only watch spot prices. Multiple dealers have privately told me, and some have said this publicly, that premiums are going to skyrocket when the next wave of retail buying begins, because there's simply no inventory in the supply chain to meet a surge in demand. One major U.S. wholesaler estimated they could sell out their entire inventory in 48 to 72 hours if retail buying accelerates to 2020 pandemic levels, and it would take months to rebuild that inventory at any price. The Perth Mint released an unusual statement on February 5th, addressing what they called extraordinary market conditions. While they didn't provide specific numbers, they acknowledged that global silver supply chains are experiencing unprecedented stress, and that customers should expect longer wait times and potentially higher premiums for the foreseeable future. Think about the mathematical impossibility of what Bian faces. He's short 450 tons in a market where COMEX lost 33 million ounces, approximately 1,000 tons, in 1 week. If just 3 or 4 other large speculators are in similar positions and try to cover simultaneously, We are talking about demand for multiple thousands of tons hitting a market that's already in deficit and where physical inventories have been declining for 5 straight years. According to data from the Commodity Futures Trading Commission's Commitments of Traders report, commercial traders, the category that includes large industrial users and swap dealers, increased their net long position by 42,000 contracts in the week ending January 28th. That's the largest one-week increase since the CFTC started publishing disaggregated data. Somebody very large is betting that silver goes higher, and they're doing it right after the crash. Here's what veteran commodity traders know, but most retail investors don't. When you get a violent price decline combined with physical shortage signals, followed by large commercial buyers increasing long positions, you're seeing professional money front-run a squeeze. They're not guessing. They have access to supply chain intelligence that tells them physical tightness is about to force shorts to cover at any price. The setup is nearly perfect for what traders call a gamma squeeze, or short squeeze cascade. As prices start rising, shorts with smaller positions cover first, which pushes prices higher. That forces the next tier of shorts to cover, accelerating the rally. Eventually, you reach the large positions like Bian's, where attempting to cover actually moves the entire market because the position is so big relative to available supply. In the 2020 silver squeeze, we saw prices spike from $15 to nearly $30 a month when investment demand surged while supplies were constrained by pandemic-related mine closures. But that squeeze didn't have coordinated government support, 54 nation price floors, $12 billion stockpiling programs, or Chinese export restrictions cutting off 120 million ounces of annual supply. This time the conditions are exponentially more extreme, and the catalyst is backed by state power rather than just retail enthusiasm. If professional analysts are correct, and we're headed to $150 or $200, Bian's $570 million paper profit evaporates and turns into multi-billion-dollar losses. At $150, his position would be underwater by $39 per ounce times 150 million total ounces, which equals $5.85 billion in losses. At $200, it's $89 per ounce losses times 150 million ounces, which equals $13.35 billion. Those aren't numbers you can just write a check for. Those are systemic risk numbers that could take down trading firms, trigger cross-default clauses in credit agreements, and potentially require government intervention in China to prevent financial contagion. And here's the final piece that brings this full circle. Our government knows all of this. Trump's team is not just supporting domestic mining or securing strategic supplies. They're engineering the conditions for the largest short squeeze in precious metals history, and they're making sure America and our allied nations hold physical silver before the squeeze detonates. That 54-nation coalition isn't defensive. It's offensive. We're not just protecting against Chinese economic warfare. We're turning their own weapon against them by creating the conditions where their traders get trapped in impossible short positions, while we stockpile physical metal at artificially suppressed prices. The next few weeks will determine whether this unfolds as the greatest commodity trade of our lifetime or whether somehow Bian and other large shorts manage to escape. But the data, the timing, the physical shortage signals, the government coordination, and the mathematical constraints on covering these positions all point in one direction. Your physical silver, if you're holding any, just became the most strategic asset in your portfolio, not because of speculation or hype, but because the United States government, 54 allied nations, supply-demand fundamentals, and the laws of mathematics all aligned at the exact same moment to support substantially higher prices. The question isn't whether silver is going higher. The question is whether you positioned yourself before the crowd realizes what's happening. Because once this squeeze begins in earnest, once those shorts start covering, once retail investors see silver spiking and rush to buy physical metal that is unavailable at any reasonable premium, you won't be able to enter at today's prices. Trump just rewrote the rules, Bian walked into the trap, and the countdown to the squeeze is already ticking.